Welcome to SNN.Network. I'm your host, Robert Kraft, and today on this Wall Street View, we have a very familiar guest, both on the podcast and, I think we've had you on now a couple times on the podcast now. So I'd like to welcome Sam Namiri from Ridgewood Investments. Sam, how you doing today?
I'm good, Bobby. How are you?
Oh, can't complain, man. Can't complain. So today, the reason I asked you to come on is that we're going to be talking about an article that you just wrote in the MicroCap Review titled "Reading the Proxy Statement to Evaluate Management." But first, for those who may have haven't heard one of our interviews in the past, real quick, what's your background? How'd you get into the wide world of investing and microcaps?
So I originally I've been investing since I was in high school. And me and my good friend Chris Lahiji would go to the library during lunch and go on Yahoo Finance during the dial-up internet days. And this was during the internet bubble. And we would, look for companies to invest in that were exciting and really just had good business models. That was really what we were looking for. And I've been investing since then as a hobby. And after that, when I was in college, I founded a jewelry company. Eventually had a TV show and a factory overseas. And then I went to Columbia Business School and realized, hey, I can be an investor as a profession. And so there I interned and ended up working at a small microcap hedge fund. And eventually in April of 2018 I joined Ridgewood and launched the small microcap fund within Ridgewood. Mm-hmm. So that's kind of my quick background and how I got into investing.
Sam, one of these days we're going to find links to the TV show that you had, and because I would love nothing more than to see that.
Yeah, it was a reverse auction format, and so it was actually quite interesting and exciting. But yeah, I mean, it aired at one point at DirectTV. Mm-hmm. We were in cable networks across the country, which was fun and exciting. And originally I was actually the host. So I'm going to give you a run for your money one day.
I figured it was always more fun on your side. All the hard work's over here. I mean, can we all agree?
Yeah.
So I got to listen to you. No, I'm just kidding. Anyway, so to dive right into the article, as I said at the beginning, the article is titled "Reading the Proxy Statement to Evaluate Management." So to start, for those who don't know, what is a proxy statement and what is it meant to do?
So the proxy statement is really the only time as an investor you really have your vote, or you really have your say into anything for a company as a shareholder. So it's really meant to inform the shareholders as to how they should vote their shares, because there's a few things that you can vote for through the proxy and as a shareholder. So it really is meant to give you an outline and guideline to give you the information that you need to be able to vote thoughtfully, I guess. Mm-hmm. So that's really the main point of it.
Mm-hmm. So then what type of content is usually in a proxy statement? Is it like new initiatives that the company wants to put out there, changes in management compensation? What types of stuff are shareholders then, up to voting for it? I'm guessing mergers, acquisitions, the whole thing?
No. So usually in the proxy, really what you're voting for is, the members of the board who are up for election, which is one of the important things that I look at is, how are the board members elected? Does every year, do all the board members have to be reelected? Is it staggered where there's only a few board members elected each year? So if you actually wanted to turn over the whole board, it would take, many years to do that if you even had the votes to do it. So that's one of the things you look for is voting of the board members. The other thing is the compensation that gets voted on every year. So you're able to see the compensation of executives and board members. So yeah, that is another thing that's important and is looked at and voted on. And then like the auditors, like ratification of auditors, that's another thing that's typically voted on. For mergers and acquisitions, it depends on the company and also the terms of the deal. But if there ever is a shareholder vote there, they send out like a special proxy, which isn't the typical annual proxy that that I'm talking about in the article.
Got it. So then for any type of proxy, and this is really for new investors that may not have even invested in a stock yet, or have and just haven't seen a proxy, so they don't know what it looks like. I mean, what does it look like? I mean, does it come into your inbox? Do you get an alert on your TD Ameritrade account? How does it look and come in? And then what do you usually do to submit your answer to it?
Yeah, so it does come into you do get a message, and a lot of times, even I get sometimes too many messages in my accounts where it's hard to check them all. But yeah, it comes as a message saying, it's time for you to vote your shares. And you could usually vote electronically. In the old days, you used to get it in the mail, and so that's a message. But you can also it's also published if it's an SEC listed company. It's published in the SEC.gov website, so you can always go and download it there. So a lot of times, like I'll look at companies that I'm not a shareholder of, and for my research process, I'll just go download it. I use FactSet, so it's a little easier, but you can go to SEC.gov or, as we were talking earlier, ldmicro.com is another good source to get that information. So, pretty much anywhere you can get filings, the same places that you get the 10Ks and the 10Qs of companies is the same place you can find the proxies. But the proxies, the actual, I think, formal name of it is called the DEF 14A.
Mm-hmm.
So proxy is kind of the pseudonym, or I don't know,
like when we're talking, person to person, it's the proxy statement, but like to actually find it on SEC.gov, it's the DEF. Is it the DEF 14A?
Yeah, I'll try to block out the company, but I don't know if you can see this. It's the form DEF 14A right here.
There you go.
So, yeah,
there you go.
And so this proxy here is a proxy for about a 300 million market cap company, and it's about 48 pages in length. So if you want to read it cover to cover, it's a pretty long read. But if you go to like larger cap companies, they get from like 150, 200 pages in length. So when management's writing up these proxies, well, they're lawyers, but when they're telling their legal team to write up these proxies, I mean, is that intentional that they'd make them so long so that they know, like, all right, as a common shareholder, you're like, all right, yeah, fine, yes, no problem, because you just don't want to go through the whole thing. Yeah, and I think most people don't go through the whole thing. Most people just go really through the compensation. They're trying to see, how much the board and the CEO and CFO get paid, just to make sure that it's like not egregious, and also, and also to make sure that, they're not getting paid in a way where they're not really aligned with shareholders. So, sometimes you'll see, people get these huge car allowances, and that shows up in the proxy. Or there's related party transactions, which, the CEO is like self-dealing with another business that he owns, which are big red flags to, that I look for when I look at the proxy statement. And then you'll see like occasionally as well, like, some of the executives, there was a bank that I had I currently have an investment in, actually. And this year, the CEO got a huge, it was like a $25 million equity, like stock comp this year, because the stock did really well. And so, they definitely had some bad formulas for that company in terms of comping the CEO, because that's quite egregious for, he was one of the highest paid bank CEOs, and it's like a small cap company. So, that's definitely something to watch out for.
So then, as an investor and shareholder, how is the proxy statement helpful to understand the motivations and incentives of management?
So, really, the overarching theme that I look for is management really working for the shareholders, or are they working to help the shareholders, or are they working to steal from the shareholders? And that's really what I'm looking for when I analyze a proxy statement. And I mentioned related party transactions. That's one thing that I look for. But it's really in the way that their bonus compensation is structured, and also their equity compensation. But first, I obviously look to see that their base salary isn't too high, and relative to other microcap companies of their size. And so that's the first thing you always look for. And then it's also like, what metrics does the board the board or the company look for to evaluate the CEO. So a lot of times, if a company looks at earnings per share, which you would think, oh, that would be a great metric for, a company to evaluate the CEO. What the company ends up doing is they end up buying more shares back as a company, and that just lowers the share count. So it makes the earnings per share look higher, even though necessarily net income didn't increase. So that's like a tactic where they'll use it, and that ends up incentivizing potentially bad capital allocation. As a shareholder, that takes away value from us. So that's one thing. And then also, like, what I really look for, I guess, is to make sure that they're aligned. And I'm a long-term investor, so I look for long-term metrics that are used to evaluate, whether the CEO is doing well. So like a 3-year, return on invested capital is something that I think is a really good metric, because that really makes the executives and the board think about capital allocation in a good way. So that is like one metric that I really look for. If a company has that, that's like a solid board, a solid management team, and they've really aligned themselves with shareholders as well too. So that's one thing that I use. And then that's really one of the biggest places. And then just to make sure that people aren't taking advantage. Like if a microcap company has a private jet, that's usually a red flag. If the board, the other thing I also look for, which is not necessarily on the proxy statement, but the proxy statement helps me find that information out, is I like Google search all the board members, and I try to see, like, do they have a bad past? Do they have any red flags, like, in their history? What other companies have they been involved with, and how have they performed? Those are things that they don't show up on the proxy statement itself, but they will show up in Google or in other search engines, and you investigate on LinkedIn is a good source, and just reaching out to them and talking to them directly to see like how they actually know the CEO. Or are the board members friends with the CEO? Do they know each other in the past, or was it like more of a strategic, thoughtful appointment by the executive team to put those
so
guys
you're looking at like board structure for that, because that's pretty important. Or is that outlined really in the proxy statement, or is that something that you have to do kind of outside of that?
No, you use the proxy statement really to look them up, and then outside of that you do that. And a lot of times you can ask, you can just straight up ask the CEO and say, hey, how did you know the board members, and how did you meet them, and did you know them from before? And so that's a question that I ask management teams generally, and I also ask them, like, when I ask the CEO if he how he hired the CFO, and even the next level of management down that's just like a due diligence question that I ask.
What's interesting is I'm not sure if I just did an interview with Jeff Graham, and it may or may not be live by the time this goes out, but he was talking about when we have friends, or I was like using the country club or the yacht club friends that happen to now be on the board. I said, is that really a problem? And his answer was kind of interesting. It's like, well, look, it can be, but it also cannot be. For you, is that something that's a problem, but or not really, if the company continues to deliver and deliver value for shareholders?
Yeah, I think that another thing I actually didn't talk about, and what your question just reminded me is that the proxy does show like who are the biggest shareholders, and so it doesn't bother me if they're big shareholders of the company, and they're especially if they're buying back stock in the open market, with their own hard-earned cash. That doesn't bother me. But if they're freely handing out shares, just for showing up, then it's like they all show up. This is just like they should all show up to the country club, do a board meeting, get a lot of free shares and cash comp, and they're not really doing anything. And most people sit in the board meetings, and they don't want to be disliked. They don't want to do something that's not potentially right for the company, but it's against what the CEO wants to do, or it's against his own personal interests. So it's really hard for people to stand up in a board meeting. At least from what I've heard, I've actually never been on a public company board, but from all the people I've talked to and all the activist investors out there, like Mr. Graham out that you talk to, they would likely say the same thing. So yeah, so again, it doesn't matter to me as long as they do the right thing as a as a shareholder, and they're aligned, and they do, just do what's best and what's right. So, and what's either a lot of like microcap companies, I don't think they quite get capital allocation and how to actually truly create value out of it. And there are a few companies out there that on their slide decks they'll show like their capital allocation strategy and when they would buy back shares, when they give out a special dividend, when they acquire another company. Like it pretty much puts out it outlines their strategy exactly. Like, okay, if our share price is below this stock price, we're going to buy back shares because that's the best use of our free cash flow. And so whenever you see companies like that, typically the share price over the next like 6 months to 2 years, from my experience, goes up quite a bit. And I think it's because, when they go out and they, go to these conferences and they have other webcasts where they, talk about, where they show people their investor deck. When an investor sees that, they really see, okay, this team and this management team and this board really gets it. And that's how you really can add value as a public company. And so a lot of business operators don't truly get that. And to be honest, when I was running my own business, it was a private business. I didn't, get that either, because as a private business, you don't have the opportunity to buy back your own stock.
Right.
And so a lot of people in the microcap world, they look at being a public company as an acquisition vehicle, and they use their stock to acquire other companies. But they should look at it in that that's a fine thing to do when your share price is overvalued. But when it's undervalued, you should be buying back shares. So that's the thing that a lot of microcap companies don't do. But it's when you find one of those, that's when you could find a company that really can create true wealth for both the company and its shareholders.
Just they treat their shares like gold.
Yes, they treat it like gold, and when it's priced lower than the market value of gold, or what the real the intrinsic value of gold should be, which I don't know what the intrinsic value of gold is ever, but like it's like you can buy it back at a cheaper price, and then that it's very likely that you'll be able to get it at a you're paying a good price for that business. You're buying it at a discount. So whenever you can buy something at a discount, you should do it. And instead of buying another company, which is you never know what you're going to get when you buy a business that isn't your own. It's like why not buy what's something that's a known quantity versus buying something that you never know could have some demons in its closet.
So getting back to the proxy statement itself, one thing that's interesting in this interview is you're covering quite a bit of things that you can look for, that you can uncover in the statement itself, and you even showed this one happens to be 48 pages, some of them can be 150 pages, but for those who may be thinking like, oh man, like I already got to read an SEC filing that's 30 40 pages, now here's another proxy statement. I'm just talking like for retail investor where this isn't their full-time gig, and but they're still active in investor. For those who may not have read it before, would you say it's difficult to understand, or is it pretty clear? Like, okay, this is what this is what that is. For kind of just to calm the nerves of people of like, all right, it's not that bad.
I think it's like with anything, the more you practice it, the easier it becomes, and the more comfortable you get with it. The first time going through a K, it is daunting. It's not a story. It's not a story. It's not a book that you read. But yeah, I mean, there are charts in there. There are, like share-based compensation is, also based off of some odd calculations as well too. And it's not quite clear until you go through more and more of them. And yeah, I mean, I don't want to say it's like easier. When it's not. I think it depends on, how well you like to read, and also like how well you understand. Like, there's not really many financial statements in a proxy statement, but there are charts and not charts, but like tables and other things of that sort that like point out, how many options are out there, and who has what options, and what's the potential for compensation, salary, base salary, or bonus, and things of that sort. And then, I mean, it is decent amount of information in every proxy statement. But it's, as shareholders of a public company, you don't have access to the inside books of a company. So they need to give you a good amount of things so that you can truly, as an actual owner of a business, you can actually decide whether you truly want to own this business or not. So I mean, it is a long document, and I think as a retail investor, I think if you're going to invest in the microcap space, you should still read these documents, even though it won't. I mean, it may take like a few hours to do, or a few hours to read it and truly understand it. But if you don't read it, then you're just taking on more risk than maybe you necessarily should, or may feel comfortable with. And I think that's why microcap kind of gets a bad rap, is because a lot of retail investors, they don't read these documents. Mm-hmm. And when you get burned, they think of it like it was bad luck. Mm-hmm. instead of being like, oh well, there was this information out there actually. Mm-hmm. And I just didn't read it, or I didn't find it or analyze it. So that's part of what I mean, I think adds value is being able to do that due diligence. And when you find something where the share structure, for instance, is really bad, and if the stock hits a certain, if the stock goes up 20%, then the amount of dilution that come from options, mm-hmm. That kind of stuff can show up. It shows up in the K, but it also can show up in a proxy statement as well too.
Well, that's where you find your edge in investing in microcaps. That's where you find the inefficiency in microcaps is really getting the opportunity to dig into these filings. And the main reason I really ask that is just as a reminder, like what you said is, and as with anything in life that's new, you gotta dig in, you gotta get used to it, and while it may seem daunting, you'll get used to the language, and also you'll realize like, okay, that's where this and this is. Okay, I know exactly where to go to find out compensation. What am I voting for? Blah blah blah. Over time.
Yeah.
Right.
Yeah, and I'd say as you get more experienced, you where red flags typically show up more and more. Mm-hmm. So you go look at those first. And so it just saves time, because if you can get to a no on an investment quickly, and you save all the time of wasting time when there is a red flag somewhere where you just will be like, okay, well, this is just too much of a risk for me to take. Mm-hmm. So that's, I think, as you get more experience, you just get to know more quickly, instead of in the past it may have taken me like a week or 2 weeks before I was like, oh no, this is a red flag, I can't invest in this company. Mm-hmm. And now it may take me like, it still sometimes takes me long, like 2 days, 3 days. So yeah.
Cool. That's cool. Well, Sam, we covered a lot here. So with that, where can my audience go and find more information about you and Ridgewood Investments?
You can go to Ridgewood Investments website, www.ridgewoodinvestments.com. You can also go and follow me on Twitter at SNamiri, SNAMIRI. And also on LinkedIn, you can follow me there. Just look me up, add me, and yeah, all the contact information is on ridgewoodinvestments.com. So feel free to give me a call as well. Cool.
And I thank you for doing this interview with me. And listen, the main reason I did it is so that I could see you in these headsets, and it's worth every second.
Yeah, I talk on the phone a lot, so these headsets, although may look annoying, it's pretty helpful and frees up my hands to type.
It's like the headgear before the AirPods. You know what I mean?
Yeah, I feel like I'm in a call center.
All right, well, Sam, thanks again, man. And I'll see you soon.
Thank you, Bobby. Take care.